Portions of this podcast use AI-generated voices and AI-assisted analysis for commentary and entertainment purposes.
Imagine holding a piece of metal so thin that a careless scratch just ruins it completely.
Right, it's incredibly fragile.
Yeah. Now imagine your company's entire survival and potentially, the infrastructure for the trillion-dollar green hydrogen revolution depends on stamping millions of these fragile plates perfectly.
Millions of them.
Millions. Oh, and you only have enough cash left in the bank to keep the factory lights on for, like, a few more weeks.
It's a terrifying scenario.
It really is. Welcome to this deep dive. We are looking at the Q1 2026 interim report from a Swedish company called Cellimpact, covering January through March.
Right.
And we're going to explore how a niche manufacturing company with this genuinely game-changing technology, how they navigate a world of frozen budgets, geopolitical chaos, and, well, brutal cash flow realities.
It's basically a masterclass in the friction between having a technology that is, completely ready for the future and dealing with a market that is aggressively hitting the pause button today. Yep. Looking at this specific interim report, it acts as a magnifying glass. For you listening, you really get to see the actual real-world mechanics of the global energy transition, completely stripped of the grand promises and political speeches.
So I want to start by looking at the core bottleneck this company is trying to solve. You listening likely already know the basics of the hydrogen economy, right?
Sure.
You know that fuel cells combine hydrogen and oxygen to make electricity, and electrolyzers use renewable power to split water and make green hydrogen. We don't need a whole chemistry lesson here.
No, we can skip that.
But the physical bottleneck for building these devices at scale, that comes down to the flow plates.
The flow plates,
yeah. These devices require stacks of these incredibly complex, exactingly patterned metallic plates to guide the gases and liquids. And stamping those plates cheaply and perfectly, it's been a total nightmare for the industry.
Because conventional manufacturing just wasn't built for this level of delicate precision at those kinds of high volumes. I mean, the standard approach for decades has been progressive forming. You feed a roll of metal into a machine and...
Like a massive press.
Exactly, a heavy mechanical press that slowly stamps it step by step by step.
But the report details Cellimpact's patented alternative, which they call Cellimpact forming, and it relies on a specialized hydraulic impact unit.
Yeah, that's the game changer.
I really want to dig into the physics of this, because the document claims it reduces tool costs by up to 50%.
Right.
And crucially, it requires absolutely no lubricants, like none. How does a hydraulic impact fundamentally change the physical process so much that you just eliminate the need for oil?
Well, it all comes down to velocity and kinetic energy. With progressive forming, the heavy press moves relatively slowly. So as it forces the metal into the mold, the metal stretches and it drags against the tooling.
Which creates friction.
Massive friction and heat. If you don't bathe the entire operation in thick industrial lubricants, the metal just tears or, the microscopic patterns warp completely.
So it's kind of like trying to force a dull, slow-moving cookie cutter through this incredibly sticky, tough dough.
That's a great way to picture it.
You have to constantly grease the cutter and the surface, or the dough just rips. And because you used all that grease, you now have a massive, messy cleanup job. You have to wash everything.
I take that analogy even a step further, actually. Cellimpact forming isn't a slow cookie cutter at all. Think of it more like a supersonic hammer strike.
Oh, wow. Okay.
Yeah, the hydraulic unit fires with such extreme velocity that the metallic substance is shaped almost instantaneously.
Yeah.
When you hit metal with that level of high-speed kinetic energy, it just behaves differently.
It doesn't drag.
Exactly. It doesn't drag and stretch in the same way. It literally flows into the mold's exact shape in a fraction of a second before friction really even has a chance to build up and cause tearing.
Because there's no slow drag, there's no friction. And no friction means you don't need the oil. That is wild.
You eliminate the lubricant entirely.
Which means you eliminate the washing phase.
Right. And in traditional industrial manufacturing, washing off those lubricants requires a highly intensive, water-heavy cleaning process.
Oh, I bet.
By removing that step, you aren't just saving water and being environmentally friendly, though, that is true and important, but you are fundamentally slashing the operational floor space.
You don't need the washing stations.
Exactly. You save on the initial capital investment for those stations, and you save the ongoing time it takes to actually produce a finished plate.
So you're cutting tool costs in half, you're saving energy, and bypassing the entire water cleaning phase. By every technical and physical metric outlined here, they have built a superior manufacturing method for a component that the green energy transition desperately needs. Millions of them.
They absolutely have.
Which brings me to the obvious contradiction here.
Yeah.
If you are holding the winning lottery ticket for a booming clean tech industry, you should be, swimming in capital.
You'd think so.
But CEO Daniel Valin's opening remarks paint a very, very different picture. He describes a highly turbulent, hesitating market.
Yeah, the technology is ready, but the capital markets are not. We really have to separate the theoretical need for green energy from the financial reality of actually building it.
Right.
The report specifically points out that the hydrogen market is dominated by uncertainty right now. Customers, and by customers we mean the massive vehicle manufacturers and the energy companies building these huge electrolyzer farms.
The big players.
Yeah, they are delaying their final investment decisions.
And the report blames this on a lack of clarity regarding policy directions,
Yeah.
changing governmental support systems, adjusting regulatory frameworks. It's like the ultimate infrastructure chicken and egg scenario.
Totally.
Like, I'm not going to authorize a $300 million electrolyzer facility if I don't know exactly what the government subsidies or the tax credits are going to look like next fiscal year.
You can't. The financial modeling for these massive projects completely relies on those regulatory frameworks being locked in.
And when those frameworks are delayed, the entire supply chain freezes. You don't buy millions of flow plates for a facility you haven't even started building yet.
Exactly. But there's a deeper macroeconomic layer here that Valin highlights, specifically regarding global conflicts. He explicitly mentions the U.S.-Iran conflict and its effect on surging oil prices.
Now, I have to push back on the logic there.
Okay.
Because think about it. You're a corporate board watching oil prices spike because of conflicts in the Middle East. Logically, shouldn't that be the ultimate catalyst to accelerate your green energy investments?
It seems like it should be.
It proves the fundamental vulnerability of fossil fuels. Surging oil prices should mean a green energy boom, right?
But in a vacuum, yes. And the report even acknowledges that these conflicts underscore the desperate need for a resilient, renewable energy supply.
Right.
But in the real world of international finance, global conflict increases the cost of capital. Geopolitical turbulence scares investors, interest rates stay high to combat inflation, and suddenly, taking out massive loans for unproven green infrastructure becomes financially toxic.
Oh, I see.
Even if the strategic need for renewables is obvious, the immediate financial uncertainty causes boards to pull back, hoard their cash, and postpone expansion.
So the cascading effect is just brutal. A geopolitical flare-up on one side of the globe causes interest rates or supply chain fears to spike, which freezes an electrolyzer project on the other side of the globe,
Right.
which means a factory in Sweden suddenly has 0 orders for their flow plates.
That is the exact vulnerability of being a component manufacturer in a nascent industry. And we also see a very clear geographic split in the report. Europe is experiencing severe delays and high uncertainty.
Yeah.
Yet, Valin notes that Asia is showing relatively stable development. Right now, Asia is actually their strongest geographic market.
That suggests the European policy paralysis is hitting way harder than the broader global trends. But let's look at the actual fallout of this paralysis.
Let's do it.
Because grand visions of a hydrogen-powered future do not cover the monthly payroll in Karlskoga. The Q1 2026 financial numbers in this interim report are just a brutal look at the realities of surviving the valley of death.
The gap between having a working product and an established market.
Exactly. So let's analyze the top line. Net sales increased by 16% compared to the same quarter last year, reaching 2.2 million Swedish krona.
Right, 2.2 million.
For you listening, you might see 16% growth and think, well, hey, growth is growth.
Sure.
But in the context of high-tech manufacturing, 2.2 million SEK, which is roughly a couple $100,000 US for an entire quarter, is an incredibly small number.
It's tiny. It barely registers against their fixed costs.
Right. The real story here is the operating loss, the EBIT.
The operating loss landed at a negative 16.6 million SEK for the quarter. Now, that is an improvement from the negative 20.8 million SEK they posted in Q1 of the previous year.
So they are aggressively cutting costs.
They are, but the burn rate is still severe.
Which brings us to the most terrifying number in this entire document. Cash and cash equivalents at the end of the period were down to 3.95 million SEK.
It's a precipice.
I ran the math on this while I was reading the report.
Yeah.
If you are burning 16 million krona a quarter and you only have 3.9 million in the bank, You don't have months of runway, you have weeks.
Weeks, at best.
Your fixed costs, the machinery, the lease, the staff, they don't stop just because the European hydrogen market decided to hit the snooze button.
No, they don't. And that forces some drastic corporate maneuvering. The report details two massive structural lifelines they had to secure in Q1 just to survive.
Let's talk about those.
The first was a rights issue, a capital injection where they offered existing shareholders the right to buy new shares.
It was 60% subscribed, right?
Yeah.
Generating about 23 million SEK before issue costs.
Correct.
But I've got to ask, isn't going back to your shareholders and asking for an emergency 23 million just to keep the lights on, isn't that a sign of severe distress? It dilutes the value of the stock, and it basically proves the core business isn't sustaining itself yet.
I mean, yeah, it's totally a sign of distress, but it's also just a common reality for early-stage industrial tech. You have to fund the gap somehow.
Right.
The 23 million SEK gave them breathing room, and the report is very transparent, stating the company remains entirely dependent on increasing its cash generation from operations moving forward.
So the rights issue wasn't a victory, it was a defibrillator.
Exactly, a defibrillator. But the second lifeline, this is where I think the real business acumen shows up. It's their renegotiated contract with a European electrolyzer manufacturer.
Oh, this part was fascinating to read, because it shows exactly how you untangle a paralyzed supply chain.
Right.
Originally, they had an 18 million SEK agreement, structured normally. Cellimpact makes the flow plates, delivers them, gets paid.
But as we discussed, the European market is stalled. Because of severe project delays on the customer's end, Cellimpact delivered 0 flow plates in 2025.
0.
So that entire 18 million SEK project just vanished into the indefinite future.
And future revenue doesn't pay today's bills.
It sure doesn't.
So early in Q1, Cellimpact goes back to the customer and basically deconstructs the contract. They agree to a new deal where the customer pays them 6 million SEK right now for the preparatory activities that Cellimpact had already completed.
Specifically, building the custom tooling and fixtures required for the eventual production run.
It's such an incredibly pragmatic maneuver.
It is. They uncoupled the payment for the preparatory engineering from the payment for the physical flow plates. And by doing so, they traded a frozen 18 million SEK contract for an immediate liquid 6 million SEK cash injection.
And the brilliance of it is that they didn't even lose the client. The report explicitly notes they still have a shared ambition to deliver the actual flow plates at the original scale eventually.
They just restructured the timeline to ensure Cellimpact actually survives long enough to make that delivery.
Right.
You see that same brutal pragmatism in their organizational structure, too. We talk about burn rates and capital injections, but, survival strategies have a human cost.
Yeah.
The CEO notes the adaptation of operations has had a clear impact on costs. When you look at the workforce metrics in the report, headcount dropped from 40 employees down to 29.
That is over a 25% reduction in their staff.
It is.
It really grounds the entire conversation. We can sit here and marvel at the physics of supersonic hydraulic metal forming all day, but when global supply chains freeze, real people lose their livelihoods.
Absolutely.
You trim the operation down to the absolute bone, just outlast the market hesitation.
And once you've cut costs to the bone, you have to find new ways to generate revenue immediately. You cannot just sit around waiting for the hydrogen market to wake up.
Which introduces the strategic pivot. This was the most compelling part of this entire Q1 report to me.
The strategic expansion, funded partially by that 23 million SEK rights issue. Because if the green energy sector isn't buying, well, who is?
Exactly. They are taking this highly specialized, patented forming technology and actively pitching it to mature industries completely outside of the hydrogen sphere.
The document lists several new applications. They're targeting manufacturers of cutting machines, cooling plates, and heat exchangers.
They also mention precision embossing, I think.
Right. There is a specific concept highlighted called Cellimpact cutting, which the report notes is fully developed and ready for production the second they get an order.
So they are walking into traditional non-green manufacturing facilities and essentially saying, hey, we built this zero-mess, high-velocity hydraulic press to save the planet, but it turns out it can stamp your HVAC heat exchangers faster and cheaper than your current machines, too.
That's pretty much it. And the rationale behind targeting mature industries is vital here. Mature industries are not paralyzed waiting for government subsidies or tax frameworks to be established.
They already have their markets.
They have existing functioning supply chains. An established manufacturer making cooling plates has clear industrial needs, shorter lead times, and highly predictable decision-making processes.
the math makes sense, they just buy it. They don't need to wait for a geopolitical conflict to resolve.
Exactly. It's an attempt to bypass the macro uncertainty entirely by integrating into markets that are already moving. And the Q1 report actually highlights early sparks of success with this strategy.
Yeah, let's look at those wins. The CEO points to a zero.6 million SEK follow-up order for flow plates. Now again, to you listening, 600,000 krona sounds like pocket change compared to a 23 million rights issue.
Yeah.
But the underlying mechanics of this specific order are what actually matter.
It's all about the margins and the speed of execution. This order was a high-volume series for an existing U.S. customer, specifically for material handling product like hydrogen-powered warehouse forklifts.
Okay.
Those are vehicles that companies are actually buying and using today, unlike massive theoretical electrolyzer plants.
But the really key detail the report highlights is that Cellimpact was able to fulfill this order utilizing raw materials they already had available in the factory. They didn't have to spend a dime procuring new metal.
That transforms the entire financial profile of the sale. Converting existing paid-for inventory into a finished product means the revenue from that order drops almost directly to the bottom line as pure cash.
It's a high-margin, immediate return transaction.
Exactly. It turns literal dead weight sitting on the factory floor into the liquid capital they desperately need.
They also highlight finalizing the delivery of custom tools to an Asian vehicle manufacturer. The report notes that delivering these highly specialized tools solved a long-term challenge that the customer had been grappling with.
Which serves as a great proof of concept. It validates that their high-velocity forming technology has unique problem-solving value in a mature automotive context outside of just making fuel cells. The report also mentions receiving a higher number of machinery inquiries globally. Selling a fully developed piece of manufacturing machinery is a massive high-margin deal that brings an immediate cash effect.
As I synthesize all this, it just becomes incredibly clear what we are looking at. Cellimpact is executing a classic startup survival tactic.
Oh, 100%.
They built this extraordinary technology with the singular grand vision of accelerating the green energy transition. But the green energy revolution is currently stuck in traffic.
It really is.
So, to bridge the gap and keep the company alive, they're moonlighting. They are using their world-saving tech to stamp out traditional parts and machinery for legacy industries. They're basically operating as a conventional manufacturing supplier just so the green energy dream doesn't go bankrupt.
It requires a delicate, almost schizophrenic operational balance. I mean, you are dedicating precious engineering and sales resources to pitching heat exchangers and cutting machines, while simultaneously keeping the factory primed to scale up the absolute second those massive European electrolyzer projects finally unfreeze. You're serving two entirely different masters just to maintain cash flow.
And that brings us to the core takeaway of this deep dive. When you look at Cellimpact's Q1 2026 report, you aren't just looking at a balance sheet. You're looking at the gritty, uncomfortable reality of the global energy transition.
The reality on the ground.
Exactly. You have a company armed with an objectively brilliant, cost-saving, water-saving manufacturing process. Yet they are forced to navigate a brutal obstacle course of geopolitical delays, plunging cash reserves, severe workforce reductions, and desperate contract renegotiations.
It's tough.
Understanding these niche supply chain players, the ones actually forging the microscopic nuts and bolts, is the only real way to understand the true pace of our energy future. Because if the companies making the essential components don't survive the valley of death, the trillion-dollar green infrastructure simply cannot be built.
Which leaves us with a fascinating implication drawn straight from their current survival strategy. We've detailed how aggressively they are pivoting their high-precision forming technology toward mature, traditional industries.
Right, industries where decision-making is fast, supply chains are stable, and profits are immediate.
The cutting machines, the heat exchangers, think about the long-term trajectory of that pivot.
Okay.
If this emergency survival tactic works wildly well, if they successfully embed themselves into these traditional, fast-moving markets and start generating massive, reliable cash flow, it raises a really serious question. Could their temporary, desperate pivot actually become their permanent primary business model?
Leaving the great green hydrogen revolution as nothing more than a legacy side hustle.
Exactly.
Wow, that is a wild thought to end on. If the old economy pays the bills better and faster than the new economy, even the greenest companies might just follow the money. Something for you to chew on the next time someone promises you an overnight green energy revolution. Thanks for joining us on this deep dive. We'll catch you on the next one.